The investment world is often obsessed with the question of how much money will this investment gain or how much will it lose? It can be very challenging or impossible to answer this question deterministically. It is uncertain. This uncertainty is commonly known as risk. Decisions still need to be made, and to help make informed decisions, the world of finance seeks to quantify this risk. One approach relies on such tools found in mathematics, probability, and statistics. To better understand how risk is quantified for investment securities, let's begin with a few foundational topics. One source that directly captures the risk or reward of holding an investment is the security's price. Prices can go up or down, reflecting gains or losses in a security. Changes in a security's price are generally affected by four factors: fundamental information, company earnings, industry reports, corporate debt, cash flow; the economic environment, GDP growth, interest rate changes, currency fluctuations, unemployment or inflation rates; investor psychology, bullish or bearish sentiment changes, fear or greed, risk aversion; and finally, technical analysis, crossing resistance or support levels, moving averages, relative strength indicators, etc. A factor's influence is reflected by the steady or sudden increase or decrease in the price of a security. The percentage change in price over a given time period is the security's return. For example, if a security today is priced at $100 and tomorrow it increases to $102, that would be a 2% return. Conversely, if the security fell from $100 to $98, then that would be a negative 2% return. For simple returns, the formula is the change in price divided by the initial price. Common time horizons include daily, monthly, or annual. Unless stated otherwise, we'll continue with the assumption of daily data. However, the concepts are generally transferable to any equally spaced time horizon. Sometimes it can be easier to work with log returns, also called continuously compounded returns. For small returns, these two measures are approximately equal. Given a sufficient history of prices, we can now compute a time series of security returns. This will be the main input for several quantitative techniques developed later. Notice that there are some returns that are very high, some are very low, and several in between. Now let's put each return into a group or bucket based on its size. For example, let's create 10 buckets. One for returns between 0 and 1%, one for returns between 1 and 2%, another for 2 to 3% returns, 3 to 4% returns, and higher than 4% returns, with corresponding buckets on the negative side. Then we place each daily return into its bucket. A return of 1.5% would go into the 1 to 2% bucket. A negative 0.5% return would go in the 0 to negative 1 bucket. As additional returns are added to each bucket, the bucket gets larger. We continue this process until all returns are placed into buckets. The resulting graph is known as a distribution, specifically a return distribution. Statisticians may also use the term histogram to define this charting technique. This return distribution provides a visual illustration of the frequency and magnitude of various returns. For example, we can quickly see that a majority of the returns fall within negative 1% and positive 1%. While larger returns do happen, both negative and positive, they are less frequent. Distributions may have different shapes, but the pattern shown is common in financial returns. We'll explore several topics related to distributions and risk measurements in the next tutorials. This completes the Risk Foundations tutorial.